If you have a property that you would like to analyze, you can come to alekapostolov.com, and there's this and then /DSCR dash loan, and there's this short form here that you can fill out, and I'll get that notification, and we can talk about your property and your situation. Now, what is a DSCR loan? What does it mean? It means debt service coverage ratio. It's basically a non-QM. What that means is that it does not follow Fannie and Freddie guidelines. So that's all it means when it says non-QM type of a mortgage. There is still type of a qualification, but it's again based on the rental income. So basically what it does, it compares the monthly rental income divided by total monthly housing payments, and then we see where we stand on that and what is the ratio that we're getting. So it's focused on cash flow. It has simplified documentation. It's built for investment properties. It has flexible user cases. We can use it to purchase properties. We can use it for rate and term refinance, or for a cash out if someone wants to pull cash from an existing property. Now, the only catch with the cash out is that the funds that are going to be received do need to go for business purposes. Since this is a business purpose loan, it's a simple question there, and basically you will need to answer it that you're planning either to invest in other properties or to remodel a current property, but the funds do need to go towards business purpose. It cannot go for a personal purpose. They are available nationwide, so if you are thinking about investing in other states, that's okay as well. So on eligibility, it only goes by the property. The DSCR ratio on the eligibility is one of the biggest factors. So a DSCR ratio of 1 would mean that the rental income that the property produces covers the monthly housing expenses. And those are your PITIA. Principal, interest, taxes, insurance, and association fees. So as long as it covers that, you are going to be a 1+. Now, we can do a 0. Down to 0.75. What does that mean? For example, there could be a property that you want to purchase that has tenants, but the tenants have been there for the past 10 years, and their rent is below market. So the housing value has gone up there, but the below market rent can throw that DSCR ratio below 1. So that's not going to stop us from being able to purchase that property, since we are evaluating the market rentals. When we're doing an appraisal, we also order a rental appraisal. So in addition to evaluating the property for its price, the rental value of the property is going to be evaluated as well. So that may show that the rents are below market, and in that case, you can still purchase the property even though the cash flow is negative on the property, because the lender knows that in the future you can catch up with those rentals. The credit is being checked. Minimum FICO is 620. Now, as in everything, the lower the FICO, then it will be adjusted on the interest rate. So it will go higher. We will face a higher interest rate the lower the FICO is, and vice versa. The higher the FICO, the interest rate is going to be better. It can go on an LLC, trust, or on an individual account. Some states actually require you to put it on an LLC since it's a business purpose loan. Like, for example, Florida, you will have to put it on an LLC if you want to purchase with a DSCR loan. So if you're not sure how to qualify, let's talk. The first thing to do would be to have a conversation with a mortgage person, see where exactly you're standing in the given point. What are you trying to do? Evaluate your plans, and then go from there. We will analyze the property cash flow, and we will analyze all the other expenses and see where exactly you fall. So it's not that difficult to qualify for this type of a loan. It does have a minimum of a 20% down payment, though. We will compare all the different DSCR options, and then if you're ready, we'll move on forward with the application. Now, why do investors work with Loan Factory? We are a broker. We have closed over 48,000 loans, 19.8 billion in funded volume, and we do have about 234 lender partners that are wholesale lenders. Now, out of those, there are about 30 that specialize in investment properties only, specifically DSCR. So those are the ones that we can get flexible terms. We can sometimes go without FICO. We can go with foreign nationals. If you're a realtor and you have a client who's out of country, it doesn't have documents for United States, it's okay. We can still use this as an investment loan, and we are licensed in 48 states. So some of the frequently asked questions is, what does DSCR stands for? It stands for Debt Service Coverage Ratio. Do we need tax returns? That is a no. We can use LLC, and we can use all types of properties except for manufacturers. And no, it is not meant for for a primary residence. Now, are there any questions so far? Is there anyone that wants to ask anything up to this point? You feel free to unmute yourself. Okay. Alrighty. If that's the case, we're going to continue and take a look at some real life examples of this loan and see how they might work in real life. But before we do that, what I want to show you is a rate sheet that we get from our wholesale partners. For example, this is from NewFi Wholesale, and we received, as a broker, we received this daily. So each day, every lender adjusts their interest rate, and we will receive the rate sheet. So this rate sheet is for everyone. This is the rate on a 30-year fixed DSCR mortgage for today with NewFi, and as you can see, it's 6.25 means that at this rate, the borrower will pay 0.655 points to get this rate. Now, if the borrower chooses to go with 6.375, the lender will give credit of 0.95 points. That's almost 1 point. So meaning on a $500,000 loan, the lender will give almost 5,000 in my bad. They will actually give 500 here. They would need to be 1 point to get 5. So this is the base rate. Now there is adjustments to every rate. For example, if you do 5% prepayment penalty, the rate will get better now. Meaning the rate is the same, but the cost is less. And so when people ask, what are the rates today? Basically, these will be the rates. Now, there is always adjustment, like personal level, loan level adjustments, meaning depends where's the FICO, right? If the FICO is higher, you will get more credit. If the loan to value is lower, you will get more lender credit. And vice versa, if the FICO is lower, you see in this case, the borrower will need to actually pay additional 7 points to get that same rate. So that rate is going to go a lot higher for someone that has 640. There is a lot of other adjustments if it's a condo, if there is late on the mortgage. Now, fortunately, we don't need to know all of these adjustments as an investor. I want to give you a real cool tool right here. If you go to alecapostolov.com, the first thing you're going to see is a pricing engine, and you can click on no income docs. So by simply filling out these little boxes here, it will actually do those adjustments for you. So if it's a purchase, a property, and then you punch in the credit score, you punch in the DSCR ratio, you will get exactly the same thing that we see as brokers. You will see which bank is offering which type of a interest rate and at what cost. So let's go ahead and take a look at some real life scenarios, and then we'll come back to this window and see how much that will cost. So I want to show you a couple of properties that are actually located in the Phoenix area that are actually for sale right now that we can use as a case show to see how would that work with these DSCR loans. For example, this one on 3105 West Madison Street is been for sale. It just got a price cut. Now, we're not advertising the property. We just want to see how this will work if an investor wants to purchase. And if you have a property that you would want me to evaluate, you see how the process is going to go. So this property is a 3-unit. Basically, it has 3 different units. It's been sitting on the market for 106 days. And we have the rent roll here for the property, and that's always good to be organized with this rent rolls. And as we can see, this property is generating $3,750 in monthly income. There's 3 units. Each unit is 3 beds, 1 bath, and each unit is generating $1,250. Now, for people that live in the Phoenix area, we know that this is a little bit on the lower end, but we also need to factor in the location, the condition of the property, etc. So but on the lending side, we do not analyze any other expense. Now, this is something that I really want to alert people that don't only count on what if the lender gives you the green light, yes, you qualify for this property, it does not always mean it's a great smoking deal. You still need to do your own due diligence, see the condition of the property, look at the maintenance and all the others. Aspects of it. This is just the financial aspect of the loan, and yes, the investor experience does play a role. It was one of those variables in the adjustment. So if you are a more experienced investor and you can prove that, you do get a little bit of a better rate. So for the sake of our example, we will take a mortgage calculator for a DSCR loan, and we will try to see how the numbers are going to work. So let's say we do purchase that property for 515, even though at 100 plus days, we can probably negotiate it a little bit lower. And then let's say we do use the maximum allowed leverage of the loan to value, which means we are putting 20% down payment, and we're taking out a loan of $412,000. Now, the interest rate, we can always go back to that page that we saw earlier on Alec Apostolov, and I identified here, I punched in all the numbers, which is 515. The loan amount is 412. We're going to assume pretty high FICO score, and we are going to get the numbers that we're seeing right now. So out of all this interest rate and different lenders, I believe that this one here is the best deal, even though it is a charge of $1,000 and $1,030 to pay for this rate. Is much better than some of the other lenders. And it's much better than, for example, paying $12,000 for 7% or receiving $1,500 for a 7.125 rate. So with just a $1,000 of a payment to buy down the rate, we can get a much lower rate at 6.875. So back to the calculator, with this rate of 6.875 and amortization of 360 months, which means it's a 30-year fixed mortgage, and the taxes and the insurance are also going to be factored in. We're getting a monthly mortgage payment of $2,706.55. That again is the rate that the lender is giving us. That's just for principal and interest. And then when we put in the other housing expenses, the taxes and the insurance, we're getting to $2,926.55 per month, which means this DSCR here is at 1.281. It is cash flowing. So basically, we have about $750 left per month after all the housing is paid off. Okay, so that's that example. Let's take a look at another one. That's the one we got here on Polk Street. This is a little bit of a different scenario. This is also a multifamily. It doesn't have to be a multifamily, by the way. It can be a single family property as long as that, again, the rental is covering or it's close enough. So this is also a 3-unit, and we got the rent roll for this one right here. So it has 3 units. There's one that's 2 and 1. That one, as we can see, the lease expires tomorrow, and it's at $1,841. One unit is vacant, and one unit it's one bedroom, one bathroom, and that one is at $950 per month. Now, what do we do in this case? There's $2,791 in income that the property is currently producing. Now, when we face this situation as lenders, we're still going to run, like we talked earlier, a appraisal, of course, for this property. Apart from the value of the property, we will also get the rental evaluation. So in this case, the appraiser is going to estimate what can we get for this one bedroom, one bathroom unit. They will check the condition of it. It doesn't necessarily have to be the same as the other unit. If this unit is in a better condition, if it has been recently renovated, we may be able to get more for this unit. But as lenders, we will go with that value, the value that the appraiser gives us. So we will add that to this monthly rent roll. So if we want to do another calculation of this property, we're going to take the 2,791, and let's say the other unit is going to give us another $1,000. So right now we're at $3,791 incoming for this property. So that would be $3,791. Now this one is for sale at $529,995. So let's say $530. A little bit more than the other one. So at $530. And the loan amount, again, let's say it's going to be at 80%. So on 530, 80 LTV is going to be, the loan amount is going to be 424. So at 424, and let's say we can get the same interest rate, which should be right around there. That's the value we're getting for the rent. The taxes are going to be probably a little bit higher on this one. The hazard insurance should be also a little bit higher. And again, we're gonna get to a monthly mortgage payment of 2,785. Similar PITI, a little bit higher, but again, this property cash flows at 1.39. It's not too much. It's not crazy, but this type of a loan is usually as exit strategy for investors that are doing the Burr strategy. So with the Burr, we know that we're buying most likely with a hard money loan, the property that's in a situation that needs to be remodeled, and by doing that, that is how we add equity into the house. So when we add that equity, basically that 20% of down payment, because we are only doing a loan to value of 80, it should give you the originally invested money back. So if you put the 20% down payment to purchase a property that's going to be a fix and flip, in that case, you will refinance afterwards and you will get that back, and the equity is going to be there in the house. So that's basically it in a nutshell. I want to stick to the time that we have in about 30 minutes. I don't want to overload everyone with information. Are there any questions at this